Good morning, everybody, and happy Friday. Welcome to another episode of Benzinga's Pre-Market Prep. I'm producer AB filling in for my man Mitch and Joel, and we've got Dennis Dick hanging out in the background. So let's go ahead and roll that intro. When we come back, we've got a lot of topics to talk about. Some earnings coming in. We've got Foot Locker came in, just absolute disaster, bringing down a lot of other retail clothing names as well. We'll take a look at stocks like Nike, you name it. And then as well, on the other side, you had John Deere, who, absolutely crushed it again. John Deere trading up. Applied Materials reported as well. We have some other headlines to talk about. We will be joined by Jonathan Corpina at 8:35 a.m. Eastern. So packed show. Excited for it. Let's go ahead and roll that intro and bring Dennis on when we come back.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elkanin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, Mr. Dennis, how are you doing this morning?
Not too bad. What's going on?
Not a whole lot. Looks like we're going to have a nice day here in Detroit. You're in Canada, right?
Yeah, cold. It's cold here today, too. We got down to freezing just 24 hours ago here, so trying to warm up. I'm an hour north of Toronto.
Okay. Are you a hockey guy?
Yeah, huge. Yeah.
Did you see that?
But we don't talk hockey on this show anymore. So after the Oilers and the Leafs debacle, we're pretty much done with hockey. So
Got it.
31 years now since Canada has won a cup. Yes, it was 30, but we know we cannot win it this year, so it will be 31 years since the Stanley Cup has come back to Canada. It's been an awful run for Canadian teams. We've been there, had a couple teams. Oilers were there, Flames were there, Habs were there, Canucks were there, but we've always found a way to lose. So anyways, not good hockey talk. Let's move away from that.
Got it. Well, the only thing I was going to mention, Brenda's joining us from Florida. The Florida Panthers game, I don't know if you saw, went to 4 overtimes last night in game 1 of the thing. So the game didn't end until like 2 a.m. or something crazy.
It was a late night for Dougie Sifu.
Yeah, exactly. But that's neither here nor there. We've got other more important things to talk about. Okay, so Dennis, let me ask you this. So Foot Locker reported this morning. Report was terrible. I'll go through some of the numbers right now. Yeah. EPS came in at 70 cents versus 78 cents estimate. Okay, so that's the revenue 1.93 billion versus about 2 billion estimate. So that missed as well. But then the company also lowered its guidance moving forward. So not good news in terms of like retail sales. But Foot Locker's a smaller company. Why does the market seem to like that it cares so much about Foot Locker's earnings?
Well, I don't think the market does care at all. That's why the market's trading higher. What I do think cares is the retail sector. So you're seeing retail stocks getting hit. So again, separation here. You always have some winners, it feels like, and some losers. Today we are seeing tech picking up a little bit of the slack, but we're seeing it's a very mixed market. Oil is picking up the slack. Banks are up a little bit here. So you are seeing some strength. There always is. And then Deere we'll get to in a second, which was a fantastic quarter, although it's leaking. But this Foot Locker quarter is nothing short of a disaster. Let's just talk about this on an overall, basis here. EPS guidance 2023 from 335 to 365 were estimates. That would put the PE around 8 or 9. All of a sudden, that PE almost doubles because the E is going down to 2 to 225. So now you look at it, well, they're going to make $2 next year potentially. Now it's trading the PE of 15 at 31. So, I mean, that's the funny thing. When you get into, where companies start to struggle, you think you're buying them cheap. All of a sudden, Foot Locker is not cheap anymore. This is a disaster stock. I'm not buying the dip here in Foot Locker. It's its own individual stories. There's some stocks that I was coming in on the earnings and buying the dip. This is not one of them. Maybe they come in at 30, maybe they come in, but we know Foot Locker has had, struggles here for a while. Is it Nike going direct to customer? Well, that's part of it all. But there's so many other problems here for Foot Locker. I think it's more of an individual story as opposed to the retail, as opposed to, the consumer just, not shopping. I think they're just not shopping at Foot Locker.
Yeah, I mean, and I can speak a little bit to how I know that, some of my friends that are on the younger side in their mid 20s, like how they buy shoes. And Dennis, literally none of them are going to the mall, going to Foot Locker and buying shoes. It's like you said, Nike going direct to consumer. You have other brands now on, which is a stock that's been doing pretty well, probably down today on the Foot Locker news. That's going direct to consumer as well. But on top of all that, you have these apps like Sneaker and StockX that people are also buying shoes from. eBay has made a lot of investments trying to get into the shoe reselling marketplace by making it like a better experience to buy shoes on eBay. You get an authentication if you buy like a real pair of Jordans and stuff on there. So there's a lot of competition for Foot Locker in kind of like the 21st century way with all these different apps and stuff. And I see it as just kind of one of those like older, almost like if you think about a department store selling clothes versus like a new, app or website that everyone's going to.
And there's bad reports and then there's disaster reports. And this one here is an epic disaster. So I would say on sometimes, there's an opportunity to come in and say, well, this is a one-off. Well, this, is, just, they had a tough quarter, but they're going to bounce back. This is not that quarter. This is a tough quarter combined with future guidance, terrible, combined with everything that you just said about going direct to consumer, not going to the mall. I mean, this is just not the place to have your money. Does it get a bounce? Everything seems to bounce here. Maybe it can get a bounce, but a lot of guts to be playing that bounce here. You do have some support at $30 psychological level here. We have options expiration here today. I'm sure there's some 30 puts or maybe there's some 30 options here. So 30 has some major support. You can see all those lows back when we go to where it's the middle of 2022 to where it's the end of 2022. But I'm not coming here trying to call a bottom in this one. Not for me.
Yeah, I mean, again, like you said, the report was a disaster, and on top of the bad report, you have the fact that the company might be losing market share in its space to other newer companies. So to me, something to avoid. But we'll keep watching the story. We'll watch some other retail stocks. Dennis, let me ask you this: there are a lot of people out there that economists that are still predicting some sort of a slowdown in the economy with interest rates rising and still some inflation out there. If people do start to cut back on spending, where do you think we see that first? Do you think like a something like shoe sales is something that we could see that in?
Yeah, well, you see it on big ticket items. If we do go into a recession, we've been saying, we're going to a recession for a while, but it just hasn't happened. And I mean, this consumer does not appear to be slowing down. Again, Foot Locker is an anomaly. Maybe it slows down a bit. But I think, big ticket things are scary. I mean, you think about cars, you think about houses, but the housing market keeps going. So I just don't see signs of it, which is, we keep thinking the higher interest rates have to eventually hit home, but they don't. And we know, and at least, in Canada, I know the way the banks got around this, we talked about this already, is you had 25-year amortizations on your homes. Well, they're giving out 30s, 35s, 40s, depending on who you are and how bad your situation is. I mean, it's now to the point where I believe in the statistic wasn't, I quoted it before, I'm just going from my memory here now, that there was almost zero mortgages in Canada that were amortized out further than 25 years. Now 25% of mortgages are amortized out further than 25 years. So you could just see how this happened. You literally had 25% of people with houses came in, variable mortgages, lots of variable mortgages in Canada, coming in saying, hey, look, banker, I'm having trouble meeting my payments. What can you do to help me? Well, we'll help you here. We'll just take your amortization from 25 years to 35 years, and that'll bring your payment back down to $2,000 a month. Thank you very much. Now I can go continue my, my spending. So it just undid everything that the Fed did. So instead of paying off your 25 years, you pay it off in 35 or 40 or 45, depending on your house. I heard they're going out as far as 50 years. So, I mean, this is, you keep thinking that higher interest rates are going to hurt. Same thing with cars, Aaron. I mean, 5 years was the norm. You go out, you get your car, your car payment's gonna be over 5 years. They do 10 now. They do 10. So all they did was kick the can down the road. Let your grandkids pay for these houses. Let your kids pay for your car because after 10 years your car is junk. So that's where we're at. That's the consumer. To keep the consumer going, the banks have figured out a way to get around it.
Yeah, I agree with all that. My one kind of prediction is that if we do see this slowdown, I think one area that will be leading, that we'll be able to kind of see it in as long as we're getting that data quickly, is in like travel and vacations. I think that's an area that's been super. Because I remember when was that, Dennis? Like I don't know. It wasn't. I don't think it was a full year ago, but say like 9 months ago or so, when like everyone. It was when we had two negative GDP quarters in a row, but they were
Yeah, we
slight,
were
and it was the
officially in a recession.
yeah, it was the whole argument about are we interested, whatever. And at that time, I remember like traveling, like we went to Vegas for a Benzinga, like something for Benzinga and stuff, and just
Sure.
like the planes were packed, hotels were packed, and I was like, everyone. And then you turn on CNBC and they're talking about a recession. I was like, it doesn't feel like it. Like you go into
No,
the plane, you go to the airplane, you
it never
go to a
did.
hotel. It never did. So
No.
I think if we do start to see some sort of, and maybe we'll see it from like hotel names or Airbnb, that could be an area where okay, now people aren't spending thousands of dollars a couple times a year on vacation. I mean, I would throw that in there as a big ticket item as well, because people are usually spending.
Well, people want to do stuff and they'll find the money to do it. And the biggest thing is again goes back to, what is the person's biggest expense? It's their mortgage, it's their car payment. I mean, if the bankers and the auto lenders are willing to extend those amortizations out, people don't have less money. They literally have the same amount of money then. They're just going to pay it off in a longer period of time. So, the same thing that we've done, the U.S. government has done, let's just build up the deficit. We'll just continue to, service the interest payments, and we'll kick the can down the road. 10 trillion in debt, 20 trillion in debt, 30 trillion in debt, 50 trillion in debt, 100 trillion in debt. Where does it stop? It doesn't stop. It just continues to go. They're going to raise the debt ceiling because they have no choice. And then the debt's going to continue to go higher. And, we just continue to, go farther in debt. So the government goes farther in debt. The people go farther in debt. I don't know where it stops. It's a house of cards, but the cards just continue. They appear to be glued down. So to stay on the bear train, and you can give all these arguments. Peter Schiff, we've had a lot of, perennial bears here that have given these arguments for a long time, and they make a hell of a lot of sense. The problem is the market just doesn't care. The market doesn't care.
I was gonna say
doesn't care. Tech doesn't care. The consumer doesn't care.
They might make a lot of sense, but they also might lose a lot of money. And we I think Carl Icahn in an interview yesterday talked about his short position back in 2017 and 2018 that lost his fund $8 billion or $9 billion by being short the overall market, and he talked about that mindset getting bought up in that Peter Schiff kind of.
Staying short is very difficult in the long run. This is why I never short stocks in my long-term portfolio. So again, some people are really good at it. I short stocks every single day in the day trading portfolio. I trade market neutral, equal longs, equal shorts, balancing myself out. But in my long-term portfolio, I stay invested, because when you start shorting in your long-term portfolio, the timing has got to be good. Because in the long term, stocks have drifted up for 100 years. So you are fighting that overall trend by being short in your long-term portfolio. There are periods of times where I will be short in my trading account, but this is not one of those times. Like people are saying, oh, the NVIDIA, might as well short this, it's going straight up. Shorting rocket ships is a way to lose a lot of money. Yeah, does it make any sense here at 65 times earnings? Probably not. But it didn't make sense at 60 times earnings or 55 times earnings, and the stock has continued to go higher. So I just don't short rocket ships. I like to short once, the stock is broken trend. I like to short weaker stocks, stocks that are trending down. Shorting a stock like NVIDIA or all these other ones, Microsoft, that just continues to go straight up, or AMD for that matter, which I'm long. This is a recipe for disaster. You will have pullbacks and you will, get lucky with the timing. But overall, trend is still your friend. Trend on tech is still higher.
Yeah. Dennis, do you trade a lot of options?
No.
Okay.
I sometimes do some covered calls in the long-term portfolio, which I have been doing. I do have some covered calls written on some stuff, which looks like I might get called away on a few things, because if this market continues to go higher, you get called away. But no, I used to trade options quite a bit going back 15 years ago. I don't trade them as much now. I like the equities. Stick to what you know. Stick to what you're good at. If you're a good options trader, stick to your options. You're good at equities, stick to equities. You like trading other stuff, stick to that. Stick to what you're good at. I like trading stocks.
Yeah, the only reason I asked, Jay Rice had a comment about the expected move in Foot Locker was $2.80, and he said it was a 3 standard deviation move, extremely rare. Those puts were dirt cheap. So I always find that interesting it's like anything else, right? It's like a sports gamble. If you go buy something that's not expected to happen and it's plus 10,000 or 100 to 1, just like the bigger move on an option is going to be priced super cheap, but then you sometimes have these 2-3 standard deviation moves that from a statistical standpoint are very, very rare. But if you happen to buy the puts,
this is what suckers people in. So this
right.
is the suckers trade is you'll see the media talk about, look at all the money made up buying these options. And then more people are buying options. The money is made in the long run selling options. I have my friend Chris, who's traded at Bright Trading for a long time. All he does is sell options for 15 years. He just has an options portfolio. He's just basically selling insurance to the market, and he's doing it in different ways with spreads, trying obviously, to mitigate. Basically, when you're selling options all the time, you're trying to mitigate the black swan event, because the black swan event can wipe out years if you're always an options seller. Then what does that mean? It means we get like a COVID, like 2020, where you got all this premium written, and all of a sudden the market falls 30% 1 month. And it's like, oh my gosh, I got to come good for this. So you've got to minimize the damage when you get, that, all of a sudden spike in volatility. But, overall, though, options writers make money. Options buyers lose money in the long run.
100%. Just going through.
It's just the time value's on your side. So premiums are just getting sucked dry, the time value is always on your side if you're a writer. It's always against you if you're a buyer. It's hard to make money buying options.
Couldn't agree more. And you gotta if you're gonna go out there, you're gonna learn that on your own, right? If you're buying options all the time, you can make some quick money. You can make some money. It's great, but it's not sustainable. Trust me, I've tried.
Running get the good ones. I can remember some options trades that I had back in 2000 and like maybe 4 or 5. And I can remember it was the reinsurers, and we had some event, and I was like, well, they're not pricing in the potential for this event. I can't remember exactly what the event was. But anyways, the reinsurers got absolutely rocked. And I was like, I had some puts on some of these reinsurers, and I had picked up for a quarter, like 25 cents, and I was selling for $10. And I'm like, there's a good trade. It's like, wow, you just like did 2,000% or whatever the hell that adds up to. I don't even know, quarter to, to $10 is even more than that. But you know what? You go and, that's still, there's lots of other times where you buy options and you're like, oh, I'm going to take a shot here, and it doesn't work out. So overall, I just say, if you can learn anything from this show here today, the money is made selling options, not buying options. But as an option seller, you've got to mitigate that risk of that spike in volatility, that black swan event, because that black swan event can wipe you out if you get too over leveraged on options.
100%. Just running through some different shoe names that might be moving pre-market off of Foot Locker's earnings. You got Crocs down about 1.5% on I mentioned. Also down about 1.5%. Nike down about 2.5%. Dennis, you got any other shoe names off the top of your head?
See, some of them have already been hit because most of them are already reported. The Nike is the one you think about right away, and you're like, holy cow, Foot Locker's doing bad, Nike's doing bad. But is Foot Locker doing bad because Nike's going more direct to consumer? That might be the case. Again, Foot Locker's its own story here. Crocs has already reported a fantastic quarter. They hit it anyways. So, I mean, if they're hitting stocks on good reports, imagine what they're doing to them on bad reports. A la Foot Locker, that's what you see. So on is an interesting story. You mentioned that one before. It got hit on its report, which wasn't that bad. Continues to get hit. I don't wonder if this bounces here eventually. This story here I don't think is over. You sometimes have stories go ice cold, cool off, and then sometimes stories are just over. I don't think ON is over. I think the story has cooled off. I think you got some good support down at 25. I almost wonder, and I hate buying, but you're on the third day since this, and you wonder if you don't get like, okay, we got to sell on too because Foot Locker's doing bad. I don't wonder if like a day like this, an on could actually reverse off it. So I don't think you want to be too early. You're going to see some weakness from the Foot Locker on this, some follow through weakness, but I wonder if that weakness isn't to be bought in ON.
Yeah, and it's so interesting because On is such a newer company, and I know a lot of people that are buying shoes from this company. So I don't know where they buy them. I think it's direct to consumer, or they might sell them in other places as well. But like for Foot Locker reported bad earnings, and now On is trading down. On might continue to trade down, but On could be like taking some of Foot Locker's market share. The market could so it's interesting to see that the competitors often trade together because it's more seen as just the macro. But sometimes I'm sure some of these like discrepancies and Foot Locker's losing sales. Where are those sales going? Maybe to Nike and on. So I don't know. Like you said, I don't think this story is over. I'm not in this stock right now. I'm not buying it here, but I am watching it, and I do think there is some potential. I get scared with the long-term story because I think a lot of times you have new brands like this come out, they're hot, and then a couple years go by, no one's talking about on. You know what they will be talking about?
That
Nike.
does happen.
Because Nike has staying power. Like Nike, I'm not worried about Nike going anywhere in 5 years. On it could be like a complete fad and no one's talking about it. I don't know. So
that's true. And that's always the risk when you're buying this new hot story. Is it a fad or not? I mean, sometimes you just have to ask that question. Some people think AI is a fad. That's insane in my opinion. I think AI is going to be in everything. Do I know if on shoes are going to be the coolest shoes 2 years from now? I don't know if they'll be as cool. Maybe they're still going to be cool. A lot of people thought Crocs was a fad, and Crocs stayed around here. And think about the stock. What Sierra?
Well, Crocs actually was a fad, but then it came back, and then had staying power. I will say probably
shoes with holes in them. In 2017 was $5. It's $115 here now. A lot of people thought this was a fad 2016, 2017, 2018. A lot of those people lost a lot of money.
I'm sure there were a lot of people back in 2012 that thought Lululemon was a fad as well. That thought yoga pants are not going to last. That's a fad, whatever. And that has proved to have staying power as well. So I guess you don't know. You have cases where these brands fizzle out. Then you have cases where they end up, consumers end up really liking them.
Yeah.
So Dennis, I wanted to mention one thing just because you mentioned the housing market earlier. I did see this headline yesterday from the Wall Street Journal. Home prices in the U.S. posted largest annual drop in more than 11 years in April. So from last April to this April, sales of previously owned homes fell 3.4%. So that I don't know. I mean, like
cracks.
The house
seeing cracks.
Yeah, and sales have been down still. So even as the price goes down, which should increase the demand for buyers, the sales have still been lower. So there, like you said, there may be some cracks forming. The flip side to that is at the end of the day, Dennis, I don't know what's going on up there with y'all in Canada. Here in the United States, we still have like a housing shortage. There are more people that want houses than there are houses.
And that's a problem in Canada as well.
So it's hard for me to imagine that there's going to be some huge crash in price, because when you have higher demand than you have supply, simple economics will tell us that, the price shouldn't go down a lot in that scenario. But you are seeing the housing prices start to drop a little bit in the United States. So just something to keep the eye on. Again, I don't think this is like indicative of, oh my God, the housing market's crashing, or that there's actually a lot of weakness there. Because I think it is maybe what I would consider it more, Dennis, is just some normalization.
And I've talked about this before here too. Went through a house build here where I'm at up there in Georgian Bay. And, I know what stuff costs to build, and replacement cost is the major issue here. What does that mean? So the driver of home prices is supply and demand, but another major driver is replacement cost, because if you can't find a house, let's build a house. Well, building new houses went from in Canada. So when I started, looking at building a house back in 2018, builder comes in, they're building $250 to $400 a square foot. That's Canadian prices, so you got to drop 30% off if you're in the US. So $250 to $400. Do you know what that range is now? So here we are 5 years later. Builders are building from $400 to $700. So you literally have almost doubled the cost of building a home in the last 5 years. What has happened to home prices in the last 5 years? They've doubled as well. So it tracks building costs and replacement costs. You can't build. So if you're building a 2,000 square foot home in Ontario and you're going middle of the road here, it's almost $1 million to do it, which is, insane to think about. So about 700,000 US. I mean, this is just the cost of doing business. Labor is up, materials. Yes, lumber has come down, and people quote lumber, but it's only, a portion, 15 to 20% of what goes into your home. There's a lot more stuff that goes into your home than lumber. Steel is way up. The labor, which is almost half of it, has increased, and people do not take pay cuts. So you can say, oh yeah, the labor will come down. Labor never comes down. People don't take pay cuts. If they're charging you $70 an hour, it's going to continue to be $70 an hour. They're not going to say, oh yeah, we'll take 50 or we'll take 40, because you know what? A lot of their employees are making $30 to $40 an hour here now. So I mean, this just the wages don't come down. So as long as material costs stay high, which they have, but more so as long as that labor costs stay high, which don't come down, it's hard to envision a scenario where housing prices crash.
Yeah, I mean, again, like it's there's so much demand out there. I mean, you can't count how many 30-year-olds there are in the United States that want to own a house that are priced out right now. So they'll be ready to go if there is any sort of correction or crash. Dennis, let's get back to earnings real quick. We talked about Foot Locker's disaster. On the flip side, you had John Deere, who basically, I mean, like the tale of two cities here for John Deere. Let me go ahead and get these pulled up. Like you said, the stock is leaking. What's going on here in the pre-market trading?
It's leaking a little bit from those highs. This is one that I've been bearish for a long time, and this quarter was really good, so I'm actually surprised. I've been bearish the stock since the 420, 430, 440. It kept going up. I got bearish around 420, kept going up 440, and it's leaked since. So I've been correct on this call. It surprised me how strong this still is. This is still throwing up big numbers, man. So I mean, the earnings report was absolutely fantastic from face value. Now I haven't dug into the reports here to the details, but I can tell you 965 versus 859, 17.39 billion versus 14.83 billion. That all looks good, and I don't see anything with the guidance here yet. Which obviously there's probably some guidance kicking around here somewhere now, but just taking those numbers at face value, it's an impressive quarter. Stock has been beat up, so people weren't expecting that much here either. One issue you will have is there's a lot of overhead supply here. Deere doesn't really have an AI story. Maybe maybe it does. Maybe the tractors are going to drive themselves. But, it's not as obvious of a story as a Microsoft or an AMD. Like AMD on the pullback, I was like, we need to buy that because of the AI story that's going to continue to get hot. And that's why AMD has been the driver. Here, Deere, I mean, it's getting a pop, but it's already starting to leak. Does it continue to have, sustainable, like, are people driving there? I got to get into Deere. I don't know if it's going to be the driver of the next bull market here. So even though the PE is cheap and the stock looks cheap, I'm still not sure this is like the stock that you want to be in. But I love the quarter.
Yeah, I mean, like you said, from a face value, this quarter is absolutely unreal. I mean, you don't typically see, unless you're talking about like the Apples and Amazons of the world, you don't typically see sales come in by such a, I mean, 14.83 billion was the estimate, 17.39. So beat by almost $2.5 billion on the sales right now. Great quarter for Deere. We also had Applied Materials, Dennis. Let's see how that one's trading.
It's been down. So Applied Materials, give us the earnings here quick, Aaron, and then we'll jump into the technicals on that one too.
Yeah, 1 second. It's pulled up. What was your initial bear case on Deere?
On Deere?
Yeah.
I kept thinking recession. I kept thinking this is as good as it gets. And I mean, it's worked out because the stock has come down in certain stocks. We've seen this separation between tech stocks and, industrials really to a certain extent. It's come down. But, overall, I just thought that the economy was going to slow in 2023. So, when I was talking about this at the end of 2022, that really hasn't happened, but the Deere trade still worked out because we saw this separation, regional banks tanking IWM, typically, some of the big, cyclicals, they have been coming down, oil's been coming down, certain things, and they've been buying tech in its place. It's been the tech train, and everything else has been left, on the tracks. And I don't know if that story continues. That's why I'd rather buy tech on dips than buy cyclicals on rips. So I don't like buying rips at all. And that's why I love this Deere quarter. If this was, somebody like AMD or NVIDIA throwing up numbers like this, I'd be like, I almost got to chase this. But it's just, not where I feel like the growth driver is going to be here for the next couple of years. It's not going to be the story. So there's going to be so many better stories. That AI story is going to continue to be there. Is there a bubble in AI? Yeah, there probably is, to Anne-Marie Band's point. Are we overexcited about AI? Probably. But is AI for real? Probably. So I'd rather own, tech companies on pullbacks here. If I'm putting money to work, and I have been lately, you can see the kind of stocks I was buying. AMD, Amazon. Airbnb was, maybe on, reaching here. I just thought, I wanted to get some exposure. I still thought Airbnb more like an Uber. But, definitely looking to increase my exposure in tech is what I was doing. Deere is not a tech stock.
Yeah, so going back to applied materials very quickly, let's go to the numbers here because the numbers actually on face value looked decent, but the stock is trading lower, which is something we talked about yesterday, Dennis. Like seeing when the market reacts poorly to a good earnings report or reacts well to a bad earnings report. The EPS came in at $2 a share, beat the $1.84 estimate. Sales came in at 6.63 billion, beating the 6.38 billion. So a slight double beat. The stock slips despite topping expectations.
And it's really run. We were 115 a week ago. We're 130. Like this tech run in the last week has been nothing short of incredible. The S&P's has been driven by tech. It's been, some people are saying it's upside capitulation in some of these stocks, which it might be. I haven't sold any. I haven't sold my AMD. I haven't sold my Amazon. I haven't sold any of the strength into this. I've stuck those longer term. Taking it back to applied materials, do I think the weakness gets bought? Probably. 125 is a big level for it now. Here you have shorts that are like probably scrambling, hoping, that this pulls back a little bit more. I think you want to be buying strength on weakness and selling weakness on strength. And what I mean by that is stocks trending up. Those are the stocks you want to be buying on the weakness. Stocks trending down, those are the ones you want to be selling the strength. That's why I'd rather own applied materials than Deere on these quarters.
Got it. Speaking of, before we get to our guest, tech and AI, Upstart, which is a company that uses AI to, give out personal loans and stuff. This thing was up 15% yesterday, Dennis. I'm kicking myself because I was looking at this a couple weeks ago and it was like $13, $14. And so I'm curious the reason I'm bringing this up. I saw someone in the chat talking about it, and I also wanted to hear your takes on the technicals.
Sure.
But from a more fundamental standpoint, Upstart was fairly grouped in with all these other. Upstart. This is the stock that whatever that guy's name is went on CNBC and they asked him what the company does,
right.
And he didn't know. But Upstart ran with every other high tech stock in 2021. Every other Cathie Wood-esque type growth stock, and just went crazy. And so if I pull up a weekly chart, you can see how this thing just got absolutely clobbered. But what I will say is,
you look at this and you think, what a great stock, what a great week. And you think about everybody who's bought this thing in the last 2 years is destroyed on it. The AI is giving what is happening here with Upstart is AI is giving a rally to all of these companies that are performing very poorly. So I think you want to be buying the real companies, and not that Upstart isn't a real company, but you want to be buying like companies that like the AMDs and NVIDIAs that they keep crowding into. But am I chasing Upstart? The thing's doubled here in the last 2 weeks. This stock has so many bag holders, and could it go to 30 or 35? Yeah, but there's just so much overhead supply you run into here. There's room. Don't kid yourself. This thing could go anywhere because it's wide open when the thing was $400 a share at one point in time. But I think AI is getting a lift. Like to Anne-Marie Band's point, who made some fantastic points in the show yesterday, I think AI is giving a lift to a lot of companies that don't deserve that lift. This is one of those companies. I don't want to buy Upstart.
Yeah, I hear you. And I think like we were talking about with on, I don't think the story's over. I don't think the story is over here. And what I will say is I think out of all the crazy companies that we saw run in 2021, from a purely like financial standpoint, I think Upstart's actually in a better position than some of these other like super growthy type companies. Obviously, with the demand for getting personal loans has gone way down as interest rates have gone up, because it's made it a lot more expensive to borrow money. So I don't think the outlook's been great for Upstart. I am in with you, Dennis, 100% that I'm not chasing this up here at $24 after it was literally a $12 stock a couple weeks ago. But just help me because I was looking at this stock, did not pull the trigger. Now I'm upset because it's up 100%.
Yeah,
tell me that it'll be okay.
Welcome to the life of a trader. Like you want to hear a horror story here? My Palantir, PLTR. You guys know, I've been talking about this as an AI play here. for a long time. Since April, I started as an AI. You go to Palantir website, it's the first thing they're talking about AI. I was like, this is an AI play. What happened in April? The regional banks started rolling over. They started hitting everything. I bought this thing at $8.60 and just kept rolling over and rolling over and rolling over. I had like a triple-sized position. So I was like, I feel like this is going to be a moneymaker here. And I got stopped out when it went below $8. And then it was going to report earnings. I said it on the closing print on Joel's show. I was like, I almost feel like rebuying my stock before the earnings print because I'm like, this, they're going to talk about AI. But I did not. And I've watched this Palantir now, basically go up 50% from where it was 10 days ago. And thinking, man, I called this, I got the story right, but I got the timing wrong. And, that's sometimes the life of a trader here. You can get the story right, you can pick the stock right, and you get the timing wrong. And you know what? I think Palantir continues. I think the AI story continues. I think you're going to wait for a pullback here now. Will I buy it on a pullback? Maybe, because I don't think the story is going away for, AI. And I think it could drive it for a bit. But right now, anything to do with AI is popping. And Palantir is the first thing you go to the website is talking about AI.
Yeah, I mean, if you like the long-term story, Dennis, I mean, just looking at this chart, even though it's up however 50% or however much you said, you still be getting it down here. I mean, I think, like you said, like maybe wait for a pullback, but I could be talked into buying some Palantir down here. I know Kathy Wood just added some more shares this week, so.
I think if we get a dip, I think it's one you got to be looking at on dips. I actually I keep thinking you got to go with the Spidey senses sometimes. You got to go with Spidey senses sometimes. $9, we got that, good earnings rip up over 10, and then it pulled back that 9, and that's where it had some resistance before. So it was a logical spot. I'm looking at the day on just May 15th, just from a few days here ago. That was the buying point, where it's like, okay, well, we pulled back. We had a good quarter. People have forgotten. It's leaked a little bit here. But you had the old resistance of 9 became key support. So that's where technicals can come in. Once you've identified, that you like the story and you think there's a story here, now find your technical spot. And the people who bought this at $9 were, all over it. Just very good trades.
100%. All right, well, Dennis, it is 8:37 a.m. Eastern. I suppose that means it's time to bring on our wonderful special guest of the day. We've got Jonathan Corpina hanging out with us backstage. Why don't we give Jonathan our very special pre-market prep welcome to the show, and then when we come back, we'll be talking. We'll be seeing what Jonathan's been watching. Jonathan, welcome to Benzinga's pre-market prep. How you doing this morning?
Gentlemen, good morning. Happy Friday.
Jonathan.
Happy Friday, you as well.
Jonathan, what a market we're in here. I mean, It's been the tale of two markets here for a while, where you've got, it seems like cyclicals haven't been doing great. Obviously, the IWM and the small caps haven't been doing great, kind of in a bear market. And then you have this rip-roaring tech bull market that just doesn't stop. Where NVIDIA keeps going up every single day despite a high PE. Microsoft keeps expanding on its PE. I mean, AMD is now participating in this, AI race here. Jonathan, tale of two markets. What are you seeing from the floor, and what are your clients saying?
Yeah, it's definitely a tale of two markets, right? And I think if we back up weeks ago and made a prediction about where we would be, I don't think this is where we would have come out to. You guys good? You got me?
You just static. I think you're okay now.
Yep. So I'm not sure if this is where we'd actually come out where we thought we would be, but clearly earnings season has helped. Economic data has helped. The market has ignored all negative news or negative headlines and dates that are coming and looming down the road, and we continue to trend higher. So it's good to see. Is it healthy? Is it realistic? I don't think so. I think we're going to have to get through a couple of dates coming up in the next few weeks to really determine what our next levels are going to be. But at this point, we're seeing a lot of transitioning out of some of the defense stocks, out of energy, into finance, into technology. It's just this rotational move that's here. But at the end of the day, again, we still have interest rate conversations. We still have debt ceiling. We still have these issues that are in front of us that haven't shown much clarity to them as of yet. So it's gonna take us some time.
When does first of all, thoughts on the debt ceiling. You mentioned it, so we might as well get your thoughts here now. I mean, is there any way that the U.S. government defaults on their debt? There's going to be a deal here, right, Jonathan?
Of course, there's going to be a deal. This is all posturing, right? There's two sides to this. There's the political side, and then there's the finance side. So the political side is we're going to posture. We're gonna put our flag in the sand and say we're not moving beyond this line, and going to go back and forth. And we've got president.
Oh, Jonathan.
Yep, sorry. We got President Biden coming back from his trip on an early on an early schedule to start addressing this. I think there's certainly a play towards that. But what's going to happen is that they are going to get us as close as they can to the deadline. Add a little bit of drama to this.
Yeah.
Nobody wants to default on this, right? And I don't think anybody wants to be blamed for defaulting on this. So these headlines are going to keep coming out. The headlines now are we're getting, progress is being made, talks are occurring. These are the negative headlines. Once we get a headline very soon, well, I hope we don't, but if we get a headline very soon of we're not as close as we thought, there's a gap between where we want to be, I think the market's going to overreact to that. So just be careful, because all the headlines we've seen so far are mostly positive about getting to some sort of resolution. If we see one negative headline about it, the market will overreact.
And maybe that's the buying opportunity. Maybe that's the chance to get in, because some people are looking at this market and saying, I got to buy today. I got to get in there. It's all going up. FOMO is happening out there. I'm seeing it, from my Twitter feed. I'm seeing it, from people I talk to. They're like, well, what do you think of NVIDIA? I mean, we got to buy this. Maybe it's that, debt ceiling overreaction that could happen here in the next week or two that gives us that buying opportunity, Jonathan.
Yep, I agree with you there. I mean, we can focus on the debt ceiling there. You can focus on technicals, S&P 4,200. A lot of chatter out there saying, we're not going to be able to stay above it, and this is a heightened level where we're at, and this might be a selling opportunity. Look at the VIX. VIX has been trending towards the lows in the 16s, and this is a pretty low dip that we've seen before. And once the VIX gets closer to 16, we've seen it bounce recently and bounce pretty good. So I think there's definitely some headwinds that are in front of us here as far as what the market is trending to do. But again, we've seen a lot of headlines that should have had a negative impact on this market, and they haven't. So that's the little bit of skeptical side of it for me, that I do think we're going to get a pullback, nothing significant, but every time I look at my screen, we're getting a lot of green and moving this market higher, and we're getting a snowball effect where everyone just kind of is jumping into it at this point. As you said, it's FOMO.
So, Jonathan, is that do you take importance to that, the fact that it seems like there are headlines out there that should move the market lower, but yet the market is remaining resilient and seemingly just brushing bad headlines off and focusing on the good ones? Does that make you think, okay, this is we're in kind of a bull market territory, or do you approach that more with caution, where you're like, the pullback's coming?
I approach it with caution, right? We're in this no man's land right now.
Okay.
The market has all these reasons, I think, to sell off. And when I say sell off, I'm not talking about a massive pullback in the market and overreactions. I'm just talking about, if you look at where we were a few months ago and where we are now, we should it would be healthy for us to get a little bit of a pullback here. And as we said, would be good buying opportunities. So I kind of feel like we're wishy-washy. We came into May, and everyone talks to sell in May, go away, which I'm not a believer in. And we talk about debt ceilings and interest rates and when are they going to pause and what's the outlook moving forward. Earnings season, we're not, we are concerned about top line and bottom line, but we're looking at what is the outlook? What are these companies actually forecasting for the next few quarters? They all hung their hat on the same cautionary measures that are out there. So like I said, we're in this no man's land. It's going to be interesting just to see if we can get above 42 and stay above that 4,200 level. That we're going to have to really need a push to be there. And if we don't, the market will have a reason to pull back in. Nothing significant, but I think we will see buying opportunities. We'll probably start seeing money coming out of tech, coming out of finance, doing that, cyclical rotation that we've seen before. You look at some of these tech names that you mentioned coming in, they serious returns in the last month. that really would have to start to get people to think, look, Amazon's gone from 80 to 120 over the last 4 months.
Yeah.
Does that warrant a sell?
That's the big question here, and a lot of people, are thinking that, yeah, this is the rally to sell. This is, the NASDAQ, the valuations, NVIDIA. Somebody was saying to me, upside capitulation in NVIDIA yesterday, where the stock's going up another $15 after everybody can't understand how it's at 300, it goes up another 15. I mean, this could continue for a while.
It can, but I think we'll have some short-term indications. We're going to have Powell and Bernanke on a panel today. Do I think they get really granular? I don't, but maybe they gleam some light on outlook. Next week, Thursday, Friday next week, we got some economic data, GDP, personal spending, personal income. That, as the Fed has always said that they're going to remain data dependent, those are going to be some key factors that are there. We'll get to the end of the month. At the end of the month, there's a big MSCI reweighting that'll bring opportunities for, besides significant volume, there'll be some pretty good volatility in the markets before we head into June. So, and then once we get into June, we've got debt ceiling deadlines, we've got interest rate meetings. So it just kind of all feeds into each other.
Jonathan, you mentioned that you expect there to be some rotation outside of these hot sectors like tech, and I mean, we've seen some money flow into financials from regional banks the past week or so. Do you have any ideas, any predictions, what sectors you think that money might start flowing to?
I think it might go back to some of the safer sectors right there. Some defensive stocks that could certainly be a safe place to go if this market doesn't have the ability to stay above 4,200. I think when you see that rotation into tech and it looks to come out, I think sometimes on a short-term rotation you see high dividend stocks get pulled into that equation until there is some stability in the market. So we're going to have to continue to monitor it. It's just a question of when does that actually occur? When does that catalyst make that turn occur? We have to continue to watch to see where this market goes. Like I said before, those levels in the S&P, the levels in the VIX, as S&P is trying to break through up here, VIX is trying to break through down here. We gotta see if they're able to really get through those levels.
And then Jonathan, also, I mean, you mentioned that, like, is this move healthy? Is what's been going on healthy? And I don't know, but is there any part of it, do you think, that comes down to, is there a lot of short money out there? Like, are there so many people shorting the market that it could actually be helping prop it up, or at least individual names?
I don't think so, right? I think people are too concerned to be way wrong in this market. And I don't think what we've seen, the trading activity that we've seen, doesn't indicate to me that we're seeing large shorts come into this market, because very easily, I mean, just think about next week or the week after, we get a headline, debt ceiling, come to agreement, everything's great. And then we're going to follow it up with a headline in June. The Fed's looked at economic data, taking everything into consideration, we're going to pause. Like, this market is going to rip higher on that, right? And those are two real factors, right? These aren't grasping at straws here. Those are two real things that could occur. And if those things occur, I don't think the shorts want to be playing in that.
Got it. And Jonathan, last question. As Jay Rice in the chat's talking about SPY and IWM. I mean, do you have any thoughts on just the overall market breadth? I mean, this move over the past month or so has been driven by a lot of big names. Have you been watching the IWMs from the smaller caps?
Yeah, I mean, clearly we're seeing, the activity and the rotation there. If you look at the Russell 2000, probably definitely lagging behind in performance, comparably speaking to S&P and other indices that are out there. Keeping an eye on the Russell, the Russell is really lagging behind. If you look back on a yearly basis, I see you're pulling it up there now. If you look back on a yearly basis, we're trending more down on the real lows of that sector there. So I think we're going to have to see some performance there. And that might be an opportunity now, as you see that base that's built in there. That might be an opportunity to buy in. I'm just not convinced that this lagging indice is going to take that next step up just yet. There might be a delayed reaction to that.
Yeah, I just know a lot of people out there are talking about the Russell and talking about these small caps. Gotta catch up eventually, but they just haven't been shown a lot of love out there at all. Well, Jonathan, thank you for joining us this morning.
Great.
Chat, smash the like for Jonathan. Jonathan, hope you have a great rest of your Friday and a great weekend.
Gentlemen, thank you, and to you too. Thanks for having me on.
Jonathan.
All righty, Dennis. So we've got about 10 minutes left. What's I know something's burning in your head, right? You got something to let loose about.
Well, we have
What is it?
options expiration here today, so you have to consider that there's always increased volatility at the open and at the close as you have institutions jockeying to open options positions against the stocks themselves. So expect some big moves here at the open, at the close. Sometimes they can be turning points. So consider that as well. We have seen this happen before. We have run-ups into the options expiration. The upside capitulation happens, and that's the turning point. There's always the possibility of that. I don't know if that's the case here. We kind of have been range-bound for the S&P for so long. Kind of feels like we're breaking out of the top of the range. It feels like a classic breakout here right now, so I'm still a buyer of dips. I think we just got to be careful with chasing stocks here today because it is options expiration, and sometimes you do have some reversals on these days.
100%. We got to get Tim Quast on to talk about the option expiration. I know that's one of his favorites. So I actually didn't even notice this, Dennis. Looking at the daily SPY chart, it looks like we're now at our highest level since August 2022. We've officially taken out our highs back in February, or at least from my daily chart, that's what it looks like. I could be
The
wrong.
420 is a big level. Yeah.
Yeah. So if we and then again, so this one, August 2022, if we keep running, 430 is that next level there, and then but like even over the past since last August to here, if you look, we got down to about 350 here, got down to 375, got down to 380. So it is higher lows, and then now it seems like we're making higher highs. So it's like, even though there's a lot of caution out there and a lot of people that are, can point me to this economic data point that tells me that the economy is not as strong as, we think it is, or this or that, it seems like the market doesn't care. And it's just been, it's not like the 2021 markets where it was just going up 2% every day, it seems like, but it seems like it's inching higher and showing a lot of resilience. Bears here have to be, I would not want to be a big bear right here, Dennis, because
you wouldn't want to be short.
Okay,
there's a big difference between being bearish and being short.
Okay,
so, it's okay to be. If you're bearish and the market's going up, it's not short. It's not that big of a deal. You're bearish and you're short, that's a big deal because then you're losing real money here. It's a tough market to be short. It's been a tough market to be short for a long time. I tried to be short this market. It hasn't been working, and that's why I went to the neutral camp 2 months ago. And maybe I should have went to the full bull camp because obviously a lot of stocks are breaking out. But they've been so much headlines that the bears could have won on. Where we've seen some earnings come down. The earnings weren't great from the big mega cap techs, but they kept buying them. And as you continue to see the silver lining market, you had to change your thesis from being full bearish to at least neutral or maybe bullish, because even though it may not make logical sense that the market continues to go higher, that NVIDIA can go from 55 times to 65 times earnings, that's the market we're in. And we know in the short run, moves can happen, and valuations don't matter in the short run. They do matter in the long run. They don't matter in the short run. So you've got to consider, just to flat out say, yeah, I'm going to short NVIDIA because 60 times earnings makes no sense. But now you're down 20, 30 bucks from, at that point in time, you're like, okay, now what? Well, it's got to pull back eventually. Now you're in the hope trade. You don't want to be in that. So I have very few shorts on right now. The bulls are in complete control here. As long as the regional banks hold up here, that was the real bear thesis here. I think you're going to get a pullback. I think to Jonathan's point, we're going to get a pullback on debt ceiling. There's going to be some nervousness. Oh, they're not going to get a deal done. I think that's going to be your buying opportunity. That's where I'm going to buy more stocks. If we start to see, where we get a market dip and an overreaction to a no deal potential, that's going to be the opportunity to get and redeploy some of that cash.
Yeah, and I think, watch out for those for that headline at some point, because it flipped pretty quickly. It seemed like from that was the reason the market was going down. I got the KRE up right now. Let me go back to the SPY. It seems like a week ago or so, some of these red days. That's why the market was down, was because the politicians still had not come to an agreement regarding the debt ceiling. It was looking, and then all of a sudden you get a couple headlines saying, oh no, they're making progress. The next thing you know, the SPY goes up 15 points or whatever. So, these things can happen quick, which is a good point to bring up the fact, Dennis, that like, a lot of technical traders out there think you can just ignore the news completely. And I understand it, right? Like there's a lot of algos out there that are trading just based off certain technical levels and this and that. But at the end of the day, like news matters, and news moves a lot of stocks every single day out there.
Yeah, the news does matter. And I mean, I still think technicals are one tool in your toolbox. Some traders out there, it's their only tool. They look at charts and they believe you don't have to look at anything else. And maybe if that works for you, again, by all means, continue to do it. If you've been able to make money for the last 5 years trading with just technicals and ignoring everything else, by all means, continue to do it, because you can't. Results speak for themselves. I say it all the time. If you're successful doing that, continue to do it. I have not seen, in my experience at Bright Trading, and I've seen hundreds of traders come and go, the traders that rely purely on technicals usually don't last, because there are times where you've got to lean on technicals. There's times where you've got to lean on story. There's times where you've got to lean on fundamentals. There's times where you've got to lean on relationships, and that time is all the time. I've always said I'm a relationship trader. I buy this because this is happening. I buy this stock because this stock is moving. I buy, these stocks here. The reason I bought AMD was because NVIDIA was blasting off and I thought there was a catch-up trade. The AMD has worked out very well for that reason. So, I mean, I think you've got to just, be able to, but going to the headlines, and there's so many people who say, well, the headlines, don't matter. You don't need those. I mean, this is the driver of prices, the headlines. Imagine ignoring headlines on Foot Locker. Why is Foot Locker down 25%? It's not because of the chart pattern. It's because there was a disaster quarter. So you've got to respect fundamentals, especially when you got an earnings report here. I know some of the best technical traders in the world do not hold through earnings, because you know what? It's a fundamental event where technicals all of a sudden don't matter. Do technicals matter afterwards? Sure. We already did a technical on Foot Locker and said there may be some potential for some support at $30. So you can get an idea to where it's going. But news is still the driver. Headlines are still a driver. If you're missing out on headlines, you're missing a lot of good trades and a lot of good information.
100% could not agree more. So we've got about 3 minutes left. I guess if anyone's got any stocks in the chat they want us to check out, unless Dennis, is there anything that we haven't gotten to today that we need to?
We got to do the TradeZero segment.
Oh, you are so right. Thank you for reminding me. Let me go ahead and get it pulled up real quick. Give me a few seconds.
And again, like Spinner pointing out, John Carter, excellent technical trader here. There's traders, if you're successful, I'm going to say it, I clearly said it, Spinner, if you can just trade technicals and you can ignore everything else and you have made money for the last decade doing that, continue to do it. I'm not telling you to change, but for those people who are struggling, for those people who, it's a difficult game to ignore fundamentals altogether, I think you've got to have all the tools in your toolbox. If you're building a house, it's hard to build it with just a hammer. So that's why I'm saying I use it all. I spend a lot of money on information, public information, where I'm going in. I'm using scanners. I'm using news feeds. I'm using, all of that. I think Benzinga Pro is the best bang for the buck, because I think they do a fantastic job on all the filings. I think they do a fantastic job. The setup, it's clean. It's nice. So, we can promote that there too. You can go get a Bloomberg for $2,500 a month, but I mean, that's a lot of money to spend. You got to make a lot of money to make up for that. And that's out of, the budget for most newer traders out there. But I mean, I think you've got to, have more tools in your toolbox than just technical analysis.
Yeah. I mean, I always like to do a mix of both. If I feel like if I like a story and I like something that's going on with a stock, and then I feel like the chart is also setting up for like a good trade, then that's when I like to hop in. I don't usually like to hop in, based off just one or the other. I like it to be a little bit of both. Sorry, I'm trying to, for some reason, I've got the TradeZero up, but it's not loading. Huh. This is weird, Dennis. Sorry, I don't know why, but for some reason this isn't loading on my end.
That's okay. Can we bring up the TradeZero, just the platform?
Yeah, I'll go ahead and do this. So,
we'll bring up the platform. He's not getting the intro. That's okay. We'll do the
no,
intro.
I've got the here. I'll play the intro. We'll show you guys the platform. It's a cool platform. TradeZero. Best place if you're out there looking to short stocks, do some of this stuff. It really is one of the best platforms. So we'll take a look at the platform right here. All right, so we're taking a look at Netflix's chart here. Another great day on Netflix yesterday. Dennis, what did it close up, like 10%? Did you see that move?
It was an incredible move. It was up $30. We talked about this on the show. I was saying, obviously, I'd sold my Netflix. I kind of liked the setup. I should have listened to myself yesterday because holy mackerel, it opened at the lows and just never stopped all day. That's a blast off. I mean, this whole advertising, with the, and giving you the cheaper. I mean, they're doing everything right now, Netflix. So on pullbacks, I think Netflix is a buy.
Yeah, 100%. And I mean, this is the TradeZero platform. You've got a bunch of different tools up here. The charts are amazing. I'm obviously partial to Benzinga Pro, but if I weren't using Benzinga Pro, this would be the platform I would be using. You have different things. We're usually looking at the top lists right here that show us the top movers up and down, but for some reason I'm having computer issues and not getting those to load right now. But shout out TradeZero, great platform here. Check it out if you have not already. Dennis, with that, it is 9:01 a.m. Eastern on a Friday. We made it through another week of pre-market prep. Or you did, I guess.
Yeah. And I've been fighting this one this week because I've been sick all week. My daughter obviously had a cold, and I've just been fighting this cough. And I'm like, you can see I go to the background, I'm coughing, trying to fight through it. So this has been a fight. The market is a fight, though. We got to continue to keep the fight up here. So, again, options expiration. So expect some, whipsaw action off the open. Could there be, more dips in their future to buy? I think so. And I'm going to use that debt ceiling to try to get some more of that cash put to work if we have that debt ceiling talks, start to falter.
Yeah, something to watch for sure. And thanks for trooping it out with your cold, because otherwise I would have been stuck alone the past couple of days, which something, I do for Benzinga Live sometimes, but I don't know if the pre-market prep audience, I think they would have missed you because we're already missing, Mitch and Joel. And don't worry, audience out there, Joel and Mitch will be back next week, so you won't have to look at my face anymore. But Dennis, with that, enjoy the rest of your day.
You did a great job. Thanks so much for filling in here. Thanks to the chat for all your great ideas. I learned so much from you. People always ask, why do you do the show? If you can make your living trading, which I do. I do the show because I learn from the traders in here. I get fantastic ideas from the trader. I mean, Money Mitch came to us from, he was just a chat. And, obviously he came up with, some fantastic ideas back in the day. So we meet so many good traders. So many traders have been in here for years. I met another friend, Rahit, a couple weeks ago. He was the one that threw me, AMD as, being a major AI player. I mean, I learned so much from you, chat. So thanks so much to everyone.
And thank you as well, Dennis, for your trading insights and expertise. And hope you have a great weekend.
Take care, everyone.
All righty, guys. Please smash the like if you have not already, and subscribe to the channel as well. You can follow us on TikTok, Instagram. You can follow me on Twitter down there somewhere at AaronBree5. With that, we will be getting into some live trading. Ryan and Zunaid will be taking us through some live trades. We'll be watching a lot of the hot stocks that we talked about today, Foot Locker, you name it. And then next week, we'll be back on Benzinga Live. Got some exciting guests and segments planned for next week. So again, subscribe to the channel, smash like if you have not already. And happy Friday, everybody. Stay green.